where you don't have to worry about gapping through your stop. Lots of different advantages to trading Nadex. You can trade as short of time frame as intraday, and a trade expiring in 30 minutes. You can trade as long as a week. So again, I'm going to turn things over to Dan. He's going to give you guys some education on Nadex. But again, great product. And the cool thing with it is it's made specifically for active individual investors like you and me. It's not made for the big high-frequency firms. It's made for the individual traders that's made up in this room. So Dan, at this time, I'll turn it over to you, and you can take it away.
Thanks, Morgan. And real quick, let me just do one more sound check, make sure I didn't bump anything. If you can hear me, just somebody hit a yes. Perfect. Awesome. Well, thank you, Morgan. It's always great to be here. I always enjoy the intros, the quizzes, everything. It's fantastic. It's a lot of fun to always be here. And one of the more important parts, it's fun, but it also has some great education. So hopefully I can not fall down on that one today, and actually hopefully provide a pretty good presentation on managing risk in the currency markets. It's going to be specific, or the examples are going to be specific to currencies, but you can apply this to any market, really. If you're trading futures, whether it be gold or oil, or if you're trading the E-mini S&P, we'll talk a little bit about that as we go along. As Morgan mentioned, and I'll kind of take a little bit here from his lead-in that I wasn't planning to, Nadex is an exchange. Where we're a bit different is that we're designed for the active individual trader. We're not designed for the big institutional players. They have the other markets. Our whole premise is we wanted to create contracts that were that you could trade, whether you wanted to trade stock indexes, whether you wanted to trade commodities or currencies. Whether you had $500 or $500,000, you could find a home, but you were always going to have a fair playing field. And Morgan had mentioned high-frequency trading. For those of you that aren't that familiar with it, it's basically the way exchanges have sold speed. The fastest connection. Whoever has the best computer gear and the fastest connection can win the trades. Nadex doesn't allow that. We don't allow anyone, a prop shop or anybody, to basically come in and stick their servers right by our exchange so that they can have a speed advantage. Every single member comes in through the exact same course, which is through the internet currently. And so that's just something to be aware of. Enough about Nadex. Let's get into the currency markets. Today we're going to talk about risk management and just some kind of key principles. You could spend your life, and probably should as a trader, studying and honing your risk management. That's the first lesson on that. We're going to look at a spot trade example. We're going to look at do a quick overview on spreads. I know quite a few of you are familiar with them. And then we're going to take a look at how they can combine either with your current strategy in the currency markets or as a standalone. And as Morgan mentioned, sorry if I get a bit distracted, this helicopter does tend to come about 20 feet from my window, and I think this pilot is absolutely insane, so I might, you won't be able to hear me duck, but I may actually lose my train of thought once in a while here. Real quick, future swaps, options, anytime you're trading anything, you're putting real money into a market, it may result in financial loss. Trading is not suitable for everyone. I personally find it very enjoyable. I can't think of doing, really not being involved in any way in the markets. But it does, require decision making, and we have to take responsibility. I think that's actually one of the things for newer traders that I've worked with, and even myself, it was easy to kind of almost blame the markets in some cases. That's kind of maybe where the psychological aspect of trading comes in, the market did this or somebody else did this and I lost my trade. Well, that's not the case. We have to take responsibility, and actually losing trades aren't a terrible thing. Probably some of the most valuable lessons, if you talk to anybody that's been trading 10 or 15 or 30 years, they'll say that they've learned a lot more from their trades that went against them than trades that went in their favor. We're going to be taking a look at some charts in this. This is for informational, this is educational. What we're going to focus on today is the Euro USD, so nothing that I'm going to say in here should be construed as saying, hey, go out and buy or sell the Euro USD. So with that, let's get started. Here's one of my favorite quotes from the market is Amos Hofstadter: take care of your losses and the profits take care of themselves. It's all about risk. And actually, I see Larry P is on. I'm probably going to quote him a couple times, so hopefully he doesn't get offended. I think that's the same Larry P that I'm familiar with. A couple of famous, good quotes though that I've enjoyed in the markets. Uh, this is just going to be some basic concepts. Again, risk management can go a lot deeper than this, but for the time that we have, a couple of key points, whether it's short-term or swing trading. So whether you're planning on holding that trade for 15 minutes or whether you're going to manage that trade over the course of days if it keeps going in your favor, all of the risk should be realized up front. Now maybe that's the first half an hour, maybe that's the first hour or 2 hours or 3 hours. But nobody is a swing trader because they let the market run against them for several days. It just doesn't happen. I've seen a lot of people do that and say, oh, I'm swing trading. Well, that's just foolish. If you are wrong, you get out. And this was actually one of my things that stuck with me from years and years ago now from Larry Pesavento was, the big difference with him compared to other traders, he got out of his losing trades faster. Now, kind of a little story on that. I don't know if we have any golfers on the line. I'm definitely not a golfer, as anybody that was at the Futures Industry outing last week could attest. But one thing I remembered somebody had said, it's not how good your good shots are that make you a pretty good golfer. It's how good your bad shots are. What we're going to take a look at is, it's not if I had one trade that ran in my favor for 2 days, but how did I handle the ones that went against me? Did I have the discipline to get out? And so we're going to talk a lot about, in currencies, you have to use stops. You get crushed without them if you're just trading the straight spot market. But we have to determine, it can be a pretty difficult thing. Where do we set our stop? Oftentimes we hear manage our risk, and so all of a sudden we start to see stops fly up really tight to the market. Well, they get stopped out all the time, and I've seen this transition happen a lot. All of a sudden the stop starts moving farther away, or the market starts moving, and then the stop starts sliding, whatever the case. You have to have a plan. You have to have a plan on where to get in, where to set your stop, but it can be difficult. If you're not going to use a stop, I've heard a lot of people say, I just use mental stops, and I've seen mental stops just be the downfall of so many people. The reason being, if you're going to take it out there anyway, why not just put it in the first place? If you think it hits that level and then, you're just going to wait for a bounce, you're just going to end up taking bigger losses. So if you're not using a stop, don't use a mental stop, but find another way to manage risk. And a lot of those are through options traditionally. Do we have any, just a quick poll, do we have any options traders on the webinar? Yeah. It looks like we've got a few. Perfect. If you're not familiar with options, don't worry about it. What we're going to cover is basically what I call options for non-options traders. Now, options traders can certainly enhance these, and they'll recognize probably the strategy right away. But it really is about managing risk, and that's one of the great things about an option in general is that if you're buying a traditional option, whether it be a put or call, your risk is limited to what you put up. With Nadex, whether you're buying or selling, that's the case as well. So we're going to take a look at finding a way to manage risk without having to use stops. And another thing, it's never about one trade, it's about a lifetime of trades. One of the worst things I can see happen to people is they come in and they're really super successful on their first trade, and then they begin to think it's easy, and then all of a sudden the discipline goes away. So always consider it in the view of a lifetime of trading. You want to track your trades. As I said earlier, you can learn more from losing trades than what you ever will from trades that go in your favor. I used to keep screenshots of all of my trades, and I would go back and analyze those. It really is a continuous education, when you talk about trading, it's for education forever. You'll never know everything there is to know about the markets, and that's one of the great things about it. So let's first just take a look at a spot trade. Now everybody trades a little bit different. Some use patterns, some use pivots, some use different ratios, whatever the case. So this is just going to be some pretty basic examples, and we're going to go on the premise of one trade that's profitable and one trade that's a loser. Want to make it as fair as possible. One thing also that I wanted to mention on risk, because I've done a lot of trade shows, and I've had a lot of people come up to me and go, oh, I'm a great trader. I'm right 80% of the time. That doesn't mean anything to me as a trader. Anybody that's been trading for a while, if you hear high statistics of how often they're right without seeing what their drawdown is, it doesn't mean anything. When I was a trading coach, I spoke with a lot of people, and the conversation would usually go something like this. Hey, how are things going? Oh, Dan, they're going great. I'm just about there. 75% of my trades I'm making money on, so I'm only losing 25%, so I'm right there. And I look at their account and they're bleeding cash. It doesn't matter if you're right 90% of the time if you're making 10 bucks on 9 out of 10 trades, but then you lose 400 on the next trade. So you always want to know what your post-trade risk-reward ratio was. You've got to know those two numbers. I've seen, and talked to some of the best traders I've ever met that were only right 10% of the time, but they did a really good job managing their trades that went in their favor. So let's just say we're going to place a trade. Right here, Euro USD spot, we're long at 132.00. That's the green line on the screen. The next thing we have to do is figure out where to set our stop. Now, everybody has their different things. For this example, we're just going to say, okay, I had some previous support. I'm going to give the market a little bit of room to breathe. My stop's at 60 pips. 131.40. So, okay, we place the trade. We've got our stop in. Something like this happens. Well, that's pretty fantastic. We'll just say that we took it out. We'll say that we're awesome, and we can absolutely catch the exact high at about 133.20. Well, we made 120 pips. That's fantastic. Another scenario, though, I don't know if this ever happens to anybody, as soon as you place that trade, all of a sudden it's just a whipsaw down against you, and you're stopped out. So in this scenario, we had one trade where we made 120 pips. We had one trade that lost. We lost 60 pips. And we had a risk-reward of reward to risk of 2 to 1. Right? We made 120. We lost 60. We're up 60. Now, I don't know if this ever happens to anybody else. Right after you get stopped out, all of a sudden the market rebounds. How about it? Has that ever happened to anybody, or am I the only one that's ever been stopped out almost to the pip, and then all of a sudden the market takes off and it runs in what would have been the favor? Pretty much anybody that's traded over 15, 20 minutes in their life has had that happen. It can be frustrating. It's a natural part of the market, though. Again, we can't blame anybody. The one thing we don't want to do in this scenario is just reload and go, okay, now it's running in my favor. I'm going to double up to try to make that. That's not a sensible plan. So, if there is a good reentry, if you see another indication to reenter, there's nothing wrong with that, but always do it within the course of your plan. So, on this outcome, as we kind of covered, one trade made 120, one trade lost 60. We put up 26.40 in margin, 2 to 1 post-trade risk-reward ratio. Net profit $600. I think that's a pretty good day. Had a pretty good return on return on margin, 22%. And Wes, that's a great comment. If you can't see it, he said stopped when the non-farm went in my favor. A lot of people that have a long bias lose a lot of money in bull markets. It is. It's just the case because the market, even though it might, if you look at a long-term chart, it looks like it's trending. When you get into the day-to-day chop, you got to find your entry. We're gonna talk a little bit about non-farm. We've got that coming up next week. Actually, we've got a whole series of reports. So that's a great comment, Wes, and we're gonna touch on that because what we're going to talk about is trying to alleviate those whipsaws, manage the risk on the front end. And what we're going to talk about or look at to do that is a simple contract. It is an option contract. It's available on Nadex. We call it a spread. All it is a simple short-term contract. There's daily and intraday. We've been asked for longer time frames, but I'm going to try to explain why we don't necessarily need them because we might want to use these in conjunction with our other trading, and we'll get more into that more later. They're all limited risk, fully collateralized. I saw that we have quite a few options trader on there, and as Morgan mentioned at the beginning, forgive typos. This should not say vertical call spread. It should just say vertical spread because it could be a vertical put, could be a vertical call, depending on your bias. You can go long or short. We'll take a look at that as well. They have a floor and a ceiling, so it can be traded long or short, and all of these are priced for the individual trader, $1 per tick. Basically what you have, let me flip through here, and I'll just bring out my spotlight here. If I was to trade a spread, here I've got the Euro USD, hopefully you can see that red dot on the screen, Euro USD 135.20 to 136.20. This is an order ticket. This was from the 19th of September. So this is a range of 100 pips. If I'm a buyer, so I might have a bid offer. It looks just like trading the spot market, 135.23, 135.25. If I place this trade, if I'm a buyer, if I'm buying at 135.25, the floor of my contract is 135.20. That's the lowest that can go. If I buy at 135.25, I'm risking 5 pips. If the market drops to 13500 flat, okay, I'm still not stopped out, but that's the floor of my contract. That's the lowest it can trade. Even though the market's dropped 25, I'm still only down 5. If it bounces back, and we'll look at this on a chart in a minute, I still have time. I'm basically buying time to be right. Another nice thing about these is you know getting in what your maximum risk is. My maximum risk in this on one contract was actually $5. No multiplier there, just $5. Because I've got my floor and I've got my maximum profit of 95. Now, one thing, a disclaimer here, I want to make you aware, this is not going to make you an expert on all things Nadex spreads. This is to give you kind of an overview on how they work. I'll teach you how you, or I'll show you how you can get more information on this in just a little bit. So we're going to use the same example that we used before. We've got the Euro USD spot market. It's exactly the same chart. We're going to look at the exact same scenarios. So in this case, though, and with a spread contract, and we'll look at it in a second, we publish multiple ranges each day. On currencies, there's about 70 different ranges. So there's typically a floor and a ceiling to work from. In this case, on this day, it was trading right at 13200. We have a spread. We have our floor of 13200, a ceiling of 13300. If it's a little bit longer term spread, it might be a range of 250 pips or 500, depending on the time frame. For this example, we're going to use the 100 pip range. So we've got a floor and a ceiling represented by the chart. It's an option, so we have a start time as well as an expiration time. Now, these do have an expiration time, but you can close your position at any time up to expiration. When it expires or goes to expiration, it's going to settle to the underlying market. So if you've traded our binary options, don't confuse this with binary options, because these actually have a variable payout depending on the underlying market. In this case, I'm going to say that we're going long at 132.15. Now, your first question might be, well, wait, Dan, SpotFX is at 132.100. Why am I paying 132.15? Well, we'll call that optionality or premium. It's almost like premium on an insurance policy. I'm giving up a little bit of edge to the market to manage my risk. So in this case, that's my entire risk. It doesn't matter if the market drops from 132 down to 129. My risk is 15. Doesn't matter if World War III breaks out or if all of a sudden, next week we also have an ECB rate decision, and really the decision probably won't be a big impact, but their press conference can usually have can see some good swings during that. If the market goes from 132 to 129, I place this trade, I've still only lost 15. Again, it's not just about one trade, it's about a series of them. My maximum potential profit in this case is 85 points. If I want to trade the equivalent of a Euro USD standard contract, $10 per pip, I would trade 10 Nadex spreads. Right now, one Nadex spread is $1 per pip. If I want to get that to 10, I just multiply by 10. This is basically the standard or equivalent to a mini on a per pip basis. So, we could have had the scenario where it ran in our favor the last time. I'd rather start out just with a loser. Here was the exact same market action that we saw in that stop out. And as we all mentioned, or actually it's a lot of us said, yeah, this happens. Here's the big difference between trading a spread versus trading the spot. I don't have a stop on a spread. Just because it hits the floor at 132.00 or even it shoots up and hits the ceiling doesn't mean that contract is over. It's an option. So I didn't have to use a stop, yet I had my risk managed. By the way, I put up $15 to place this trade. If I was going to place 10 contracts, it'd be $150. So I put up 15 pips risk. Now if the market does something like this, well, now I've had time to be right. I can let this contract go as long as it wants to expiration. If at expiration it's right over here, let's say it's at 133.00 at expiration, that's where the contract's going to settle. If it's at 132.40 at expiration, that's where it's going to settle. Or I can close out anywhere along here. And we're going to take a look at a combination strategy in just a little bit on this as well. Hopefully this is making a little bit of sense. Typically, if it's the first time you see it, it's going to be there's a lot of information. But we're going to look at the trade outcomes and we're going to lay them out side by side. Is Nadex 24 hours or just US session? Nadex, technically, depending on the contract, because we have different time frames, We have some contracts that do run 24 hours, but the exchange is closed 1 hour every day. So you basically have 1 hour of exposure where you wouldn't. Binaries are as long as a week. On the spreads that we're talking about, you can do a daily, which is, I believe, 23 hours. So here we have the same outcome. We had one trade. Remember, in the spot market, we made 120 pips versus 85 in this. So you might say, well, geez, why wouldn't I trade the spot? I made 120 versus 85. That's much better. But remember also, in the spot market, our trade that went against us, because we have losers as well as ones that go in our favor, we only lost 15 pips. If that trade just went to the bottom and stayed against us, we lost 15. Our margin required was only $150 versus $2,600. So when we look at our post-trade risk to reward ratio, which I think is a very, considering 50-50 across the board for all these, now we're starting to see a good risk reward ratio. Our overall profit was $700. If you took away the exchange fees on Nadex, because we are an exchange, that's how we keep our lights on, $673. The return on the collateral we put up, and this is where it gets exciting for particularly a smaller account, was 449%. And that, again, is just doing 50-50. One trade goes in our favor, one trade doesn't. In this case, Dennis, this contract was basically this could have been a 2-hour or an 8-hour. Really, the size of the contract on this one, I know it was a 2-hour, but you could also have an 8-hour that sets up with the same parameters and has a wider range and a bit more time. But again, it's all about having, remember, our risk is up front in these contracts. If they're running in our favor, fantastic. For example, I could, let me flip back one screen. For example, let's say the market came up to here. I could close out my spread. Hopefully everybody can see that red dot. I could close out my Nadex spread, and then I could go over to whatever platform I'm trading spot FX on. I could enter there, but now let's say I put in spot FX my stop somewhere down here. Well, now I've got to stop. Now I'm just managing a position because I'm already in profit. And so I can use these as a combination of both. And this will actually, to answer maybe Dennis' question as well, we publish multiple ranges based on where the underlying market is at. So we have a really wide, by the yellow there, daily, and then we have 8 hours. In this case, 250 pips. We publish multiple ones. So here's the market at 8 a.m. We can see right here we have common floor and ceilings at 130 in this scenario. As the market moves, we're going to continue to make new spreads throughout the day. So you'll always have, which is going to be important, a common floor and a common ceiling based on the midpoint of the market. So we've got this here, common floor ceiling. So let's take a look at one other strategy we can use here. Again, we're looking at the same thing. This actually goes, we're going to use a combination of spot trade, because one of the downsides to using a short-term type of option contract is it has an expiration, and with Nadex it has a cap. So we'll see how we can use those together. We're going to do the same scenario with the spot market. I want to be fair to the spot market in this one because I traded it for quite a few years. We have the same setup that we had in the first slide. We've got our stop at 60 pips. We're buying. Well, if you remember the last slide, we don't just have spreads that go up. We also have common floor ceilings. No, you cannot roll over a spread, but you can reinitiate, meaning you basically, if the spread expires, you can reassess and enter because there'll typically be another one published, soon after or another one. But no, you cannot actually roll. Now we're looking at using a spread in conjunction with the spot FX. So here we have, in this case, a range. Our floor is 131. Our ceiling is 132. Again, we have a start and an end. So I'm doing the combination here. We've got a spot trade. We had a stop of 60 pips. What I can do now is buy insurance. So I'm going to look going short the Nadex spread contract at 131.85. So I actually have two positions on here. I've got a long in the underlying market because my bias is that it's going to go up. But I want to protect myself in case the market's going down or goes against me. So I believe, I'm trying to remember who mentioned the non-farm payroll where you get the whipsaw. I think that was Wes. This might be an example of where you want to protect against a whipsaw, and maybe you use one that's 250 pips. Again, I have my risk on the spread and my potential profit. Basically what I'm looking at is this green area is insurance. What I can do now, because I still want to have a stop in the spot market, but what I can do now is move my stop down to the floor of the spread because I'm protected to that level. So I've bought myself a little bit of a cushion. If I was only using a 30 pip stop before, well, that's fine. Now I can use 100, but I'm actually taking on less overall risk. And so we'll take a look at how this lays out. But now, if something like this happens, so right, the market's come down. Before, when we were just doing the spot, we got stopped out at 60 pips. Well, now we've bought this protection. Now we're still in the trade. We could decide, hey, we were wrong, and we could close it out here, or we could wait and see. Maybe it comes down and maybe it just drops down like this, and then we get stopped out in the underlying. But instead of being stopped out for 100 pips or even 60, we lost 15 because that's all we gave up on the spread. If the market continues like this, fantastic. We still got the same run we did before, and before we said we closed out right at the top, 133.20. All I gave up of that entire move was 15 pips, what I lost on the spread. Yep, price was 132.00, Dennis. So if it goes up to 132.20 on my spot trade, I made 120. I lost 15 on my spread. If the market had dropped from 132 down to 131 and stopped us out, we would have lost 100 pips on our spot trade, but we would have made 85 on our thing. Actually, no, on the 132.00 that I bought, Dennis, that was the spot market. I was actually selling the Nadex contract. Great question on what did I pay for the insurance? What I put up for the insurance was, in order to do the equivalent of one, I sold 10 Nadex contracts. I put up $150. That was my basically premium to the market. If the market just stayed right where it was at and didn't do anything, well, then I lost the $150, but I got out of my spot as well. And I could have held it. Basically what I did with this, I took a lot of the heat off. A lot of the things from a psychological perspective that plague, particularly people that haven't been around as long, is when the market starts moving against them. Because a lot of times things come in series. Well, if I lost 60 and then 60 and then 60, I've taken a big beating in my account. But now, if I can have a stop 100 pips away but only lose 15, 15, 15, now it just it takes a lot of the heat off. I can withstand as the market starts going against me. I don't start to question myself. I'm buying time to be right. So let's take a look at what we did on the combination, because remember, yes. You know what? Let me flip back because it looks like we've got some questions. Let's see. So if it stayed down, you would have lost 300? No, absolutely not. We'd have lost. We'd have lost $150 versus if it moved 100 pips. So let's say it went down to 131.00 and just stayed there. Let's say it just settled right at 131.00. I'm going to bring my laser back. The contract runs, and we'll say price is right down here at the very corner. I lost 100 pips in my spot position, correct? So I lost $1,000 in my spot position. 100 pips, $10 per pip. I lost $1,000 in my spot. But on the Nadex position, if it settles at 131.00, I made 85 because I sold at 131.85. It's now at 131.00. That's where it settles. I made $85 per contract times 10. So I made $850 on that. So instead of losing 1,000, well, I lost 1,000 in the spot, made 850. I lost 150 on a 100 pip move against me. The premium, or whatever you pay, this will be dependent on volatility and time. with this, the span of the rectangle could be 2 hours, it could be 8 hours, it could be a day. So really depending. One of the things, and I'm going to show you how you can get a demo account to look at it, because I think one of the most important things is to actually do this yourself, and show you where you can get some resources. So what we're looking at, and actually I'll run through the numbers here and then we can flip back to this slide. But basically wherever I buy or sell a spread, whatever my risk is. So basically if, let's say I have 15 points, or let's say 20 points, I'm buying 20 points or 20 pips off the floor. So if I was buying at 131.20 and the floor was 131, I would put up 20 pips or $20 per contract. If I do the equivalent of a standard, I'm putting up $200. This is actually what I call high effective leverage. When you, it's not actually leverage because the contract itself isn't levered up, but when we look at 50 to 1 in the spot market, so if I want to trade the Euro USD at 130.100, I'm putting up $2,620 at 50 to 1 to do a standard contract. If, however, I buy a spread, let's say at 131.20, and the floor is at 131, I do 10 of those to make it at $10 per pip. Again, I have limited reward as well, but I can still get $10 per pip, but now I'm only putting up $200 to do that. No, there is no assignment at all. These are all cash settled. In case it goes more than 100 pips against me, well, that's why I left my stop in there, because I'm only protected down to 130.100. If I was wrong by 100 pips, I better be getting the heck out of that trade, because if I'm going to consider even letting it go farther than that. Now, I will say, you want to be aware. March 2009, great example. Anybody trading currencies in March of 2009? I believe it was March 19th, to be specific. Anybody? Okay. No, I'm surprised. This was a huge day. Actually, a couple days that really stick with me. March 2009. Same thing whether you're trading futures. This was a huge day. This was the day the Fed came out with the first round of stimulus, quantitative easing. If you were trading gold, there were huge gaps. If you were trading spot currencies, particularly spot currencies, I remember watching the Euro USD. I think the gap was something like 178 pips. In that case, I'm only protected for 100. I don't know about you guys. Even using this strategy, I don't want to step in front of the Fed. If I'm going to, now maybe non-farm, where you get maybe a little bit more movement, but anytime there was like speculative quantitative easing, now that's obviously a big thing. But if I'm trading like a non-farm payroll, which Wes was talking about, and it whipsaws against me, now I've bought a little bit of a cushion. Now also, if it whipsaws against me and then stops me out here, awesome. You know what? Let me close out my spread and walk away. And yeah, and Jack, I'm not going to cover when you can do the multiple spreads, but if everybody remembers there was a spread up top as well. You can do a combination of spreads. There's a lot of different things you can do on these. And we have some videos on our YouTube channel if you want to check that out. And I want to make sure I have plenty of time to answer some questions. So just take a look at how the outcomes were. We had our spot trade. Remember, this is a combination. On the spot trade, we'll say that the spot trade went in our favor right away. Made 120 pips on the spot trade. Lost 15 on the spread trade. Total of 105 for a gross of 1,050 return. Including the exchange fees, 1,041. There was $9 in exchange fees for putting on that protection, basically. Remember, we're going on a 50-50 basis here. So one spot trade, if it went against us 100 and it just stayed down there, let's say it dropped to 129.00, we got stopped out at 131. We lost 100 on the spot spread. We made 85. Total was a loss of 15 pips for $150. If you include the exchange fees, it was a total loss of 168. Well, Jeff, that is a great question. Actually, a lot of people wonder. The spreads are going to be set by floor and ceiling, and it won't necessarily always line up perfectly. There's different situations in markets depending on when you're getting in and out. you don't get to select the ceiling. In traditional options, if you're doing the week, you could buy a call, sell a call, buy a put, sell a put, and then you'd actually be able to select your ranges. We've taken that simple strategy and made it even simpler. One of the tough things about when you're doing traditional options, even at a week-long or a month-long option, you're paying quite a bit of time premium. One of the things when I look at the spreads here is basically you're getting expiration day time premium. And if you're not familiar with that, don't worry if you're not familiar with the options. Basically, the more time you have typically in a contract, the more you pay. And so by being able to implement, because remember, we're just looking at the start. We're looking at the first couple, maybe even 5 or 6 hours of a contract. Because if it's running in our favor, then our jobs as traders is to work that position, manage it. Whether you're scaling in, however you're doing it, scaling out. You can do a lot of different strategies. I mean, we could talk basically all day if we wanted to on the various strategies we could use on this. So the combination trade outcome, again, 50-50, we had one for a net of 1,041, combo of 150. The margin required on this trade, because remember we had one spot position at 26.40 and then 150 on the thing. We had two different legs, basically. Our margin required was 27.90. In this case, though, we actually got almost a 7-to-1 post-trade reward to risk ratio. That's pretty decent, and that's just based on the figures there. Our net profit for doing those two trades, remember 50-50 was 891. Our return on what we had to put up was 313. Actually, excuse me, that's a typo. Our return was 891. Well, we had to put up, so I have that inverse there. It would actually be closer to 31%. So let's just lay them out, and again, disregard this 313% here. That's a typo on my part. I believe it should have been 31.3 if I look at the figures. So we had our spot trade. We put up 26.40. Our closeout being 50-50 was 2-to-1 reward to risk ratio. Our net profit was 600. Our return on collateral was 22%. If we just did the spread, and again, we're assuming the market went to 133.20. We got capped at the 133. We put up 150. Our reward risk ratio is 5.66 to 1. So we got a really good risk reward. So if you extrapolate this out over 100 trades and consider what that'll do for your trading when you start looking at those the reward risk ratios, our profit was actually slightly higher, even though we got capped on our overall profit because of the ceiling. We actually made 700 and 449% return on what we put up. Again, because we had to put up so little basically to enter this position. When we did a combination, this one actually worked out really well in our favor. We put up 27.90. We got almost a 7-to-1 reward to risk. Our net profit on that one, and exchange fees, everything, was 891 at 50-50. And then disregarding that return on margin / collateral, that should actually be I think 31.3. I think I forgot my my punctuation there. Again, though, every trade is different. There's a multitude of different outcomes we could discuss. Your job as a trader is to manage that risk. I think options are a great way to do that. I think simplified options that Nadex offer are a great way to do that, because while this might have confused you, a lot of information here, if you get in and start trading them, that's when it really starts to make some sense. Time and volatility will impact the price. And yes, Wes, these spreads are specific to Nadex. If you go to our website, we haven't changed it yet, but they were initially called bull spreads, which is just the dumbest name I've ever heard. Well, probably not ever heard, but it's pretty dumb because you can both buy and sell. You can go long and short. To me, if I hear bull spread, I think automatically from my options days, hey, I'm bullish the market. If you go to the website, they'll be called bull spreads, or the platform. We're working on changing that. They're eventually just going to be called Nadex spreads. So what does it cost and how do you do it? As we mentioned, Nadex is a bit unique. All of our contracts are designed for the active individual trader. So it means you can get in at a basically lower price point. I don't know if anybody's, if you wanted to hold a position in oil overnight, I forget what the latest margin is on that on a standard contract, $6,800. You might be able to look at Nadex. I know not everybody has, 10 grand, 20, 25 grand. A lot of people have been priced out of markets because of margin requirements or just position risk. When I was trading oil, a $1 stop was $1,000. That's a lot of money. That's just your risk. But if you can come in and do an equivalent position or even just a smaller position, you want to trade oil, you can come in. Whatever your risk is on the trade, that's what you put up in collateral. There's also no margin calls. So you can never lose more money than you have in your account. Now, don't get me wrong, you can lose everything you have in your account. And one thing you don't want to do is, let's say you put in $1,000, you don't want to go into one trade and put on $1,000 risk. It doesn't make any sense to do that. Always work with a trading plan. Understand your risk parameters. It should be a small percentage of your account. We'll probably do one on trading plan here in a little bit, but to become a member, you actually become a member of Nadex. We are an exchange. There's no membership fee. You go to nadex.com. You can become a member for as little as $100. You can also, put in $100,000 if you like. Exchange fees of 90 cents per side in out. Expiration fee of 90 cents on successful trades. Fees are capped at $9 per order. So if you are trading futures, let's say you're trading the big gold or you're trading oil, and you want to put on 40 Nadex contracts because you want to do the equivalent of, let's say, 4 oil contracts. So you put on 40 Nadex contracts. Put those all on in the same order. It's $9 for that order ticket. So it's not just 90 cents ad infinitum. It's $9 if you place 100. Angelo, great question. Currently, no. We are only allowed to accept residents and entities of the United States. However, we are working with some brokerage firms, which we're confident we'll have hopefully within the next couple of months here on board. And we're, depending on your jurisdiction, they should be able to take from 90% of the globe, and that should be coming up here in just a couple of months. We've had a lot of interest from outside the U.S. It's really just the way our charter is with our regulators. Yeah, I'm looking forward to that day because we have had so much demand outside the U.S. And it looks like we've only got a few minutes here. Canada, not yet either. I'm a U.S. citizen but live in another country. You know what? I'm going to put up the number for customer service in a little bit. There's some certain parameters. That's always a tricky question because it depends on some factors. In most cases, yeah. And I don't want to say in most cases, yeah. I'll put up the number for our customer service and put it in. Roger B, is the money insured? The money in your account is held in what's called a LSOC, for lack of a better term. It's basically it's a swaps account. If you're talking about SIPC insurance, no, there's no such thing as like FDIC or SIPC for anything that's a swap or a future or forex. That would only be on the equity side. Yeah, definitely, Paul. I'm going to put up some contact numbers. Real quick, I want to show everybody how they can get a demo account. And even if you are outside the U.S., go ahead and get a demo account. Hopefully soon enough you'll be able to trade this through a brokerage firm. So if you go to nadex.com, nadex.com, underneath trading, click on demo trading account. It takes about 30 seconds. Name, email address, phone number, throw it in there. It's a 2-week demo, and actually Chip just threw it up as well. If you don't click on the link during the thing, just go to nadex.com, and Morgan threw it up. If you have questions, our customer service is awesome. Give them a call, shoot them an email, customerservice@nadex.com, 877-776-2339. Now, one of the things, our demos are 2 weeks long, which, that's enough to kind of get in and understand the platform a little bit, but probably not long enough for a lot of people to learn the contracts. As part of this and through our work with Trading Pub, we make this offer a lot. Anybody that has a funded live account, shoot me an email, dan.cook@nadex.com. If you have a live funded account, I don't encourage you to trade it until you're absolutely comfortable and ready. But then you can continue getting the data. You can continue trading on the demo for an additional 12 months. If you have a live funded account, again, I don't want you trading it until you're comfortable. I'd rather have you come in, you get a funded account, you trade it, you trade your demo for another month, and you go, hey, this just isn't right for me. That's fine. Take the $100 out, walk away, but you gave it a shot. I just want to make sure everybody, from a risk perspective, understands how the contracts work. Again, one other thing here, if you go underneath education on our website, education, we have a whole series of videos that go over the basics of binary options and spreads, more about the exchange and the platform, as well as the Nadex YouTube channel. So that there are a lot of resources available for that. Lawrence, actually, these are basically kind of equivalent to mini contracts, not micro. So in other words, you can't do 10 cents per pip, but you can do the equivalent of basically a mini at $1 per pip. You can trade almost all hours of the day, depending on the contracts and the underlying market. For instance, we do offer contracts, and I don't think they're that great yet because we really need more liquidity, and we need some specific market makers to our agricultural contracts, corn and soybeans. Those are traded during floor hours. If you go to our website, and hopefully you can see this red dot underneath markets, depending on what you're interested in. If you're interested in currencies, if you're interested in stock index futures, if you're interested in commodities, go to markets, click on the applicable one. It'll bring up the page, and then on the left-hand side, it'll say contract specs. It'll tell you all of the different ranges, when they trade, and everything. So you can see when they're open. And we're always closed 1 hour every day from 5 Eastern to 6 Eastern. No single stock futures currently, Roger, although we have had quite a few requests for that. It looks like we're down here to our final few seconds. I hope this was not overly confusing and that you at least picked up a couple of good bits. Alexander, you know, the live account is for U.S. only. If you're outside the U.S., go ahead and get a demo. Why not try it out? I think it'll be available for people outside the U.S. soon enough. Now, one thing, please don't call our customer service department every day and ask when it's going to be available, because then they're going to come back to me and say, "Hey, Dan, were you telling everybody that it's available now for non-U.S.?" But get the get the demo. I encourage you to try it out. Hopefully, it'll be available soon enough. What is your YouTube angle? I'm not sure what you mean by angle. If you go, or maybe handle. Oh, I'm just out of time, so real quick. If you go to YouTube, just type in Nadex and look for our logo. It's a big blue N. I hope you guys enjoyed this. I hope you picked up a little bit on this. If nothing else, whether you think the whole Nadex thing is just hogwash, but you still want to trade currencies, hopefully you picked up a bit on risk. That was the intention, because it's the most important part of trading any market is understanding your risk.
All right, good deal. Well, we hope that you guys enjoyed that. And again, here's the link for you in case you need to